Hey, it's Jordan with Cashflow AI, and today we're going to talk about the Sharpe ratio because that is the one metric that will determine if you have a strategy that looks like this orange one here, where it's very up and very down and very choppy, or this gray one here, which is very, very smooth up into the right curve, which I personally would rather have. And even though both of these strategies here ended up making $15,000, this gray one had a much higher Sharpe ratio, which allowed it to be a lot less stressful when trading it. And so we're going to talk about that in this video. So what actually is the Sharpe ratio? Well, it is the most important metric in quantitative finance, and it basically just measures not only how much you're making, but how much are you making based off of how much are you risking, right? And so the actual formula, which are going to be right here, you're going to take your excess return, which is your portfolio minus your risk-free rate. You divide that by your volatility, or standard deviation, and then you're going to get your what we call a risk-adjusted return, okay? And in plain English, the higher the number, the higher the Sharpe, the better return for the risk that you're comfortable taking on in that said strategy. And so the reason why this is the most important metric is because, first example, if you're a hedge fund or a quant or whatever it is, you can have three different strategies. One of them has a medium return, one of them lower, one of them higher. But if the higher one return comes at a lot more risk, it may not be the strategy for you. You may rather trade one that has less return because you're taking on way less risk. And if you decide to be more aggressive with that strategy, because that has our Sharpe ratio, so you can afford to do that, then you can end up making more money long term. But really, because most quants think in a way of how much can I get based off how much I'm risking, not how much total capital or how much total profits can I make, Sharpe ratio is really the metric to go off of, and that's what they optimize for. So what is actually considered a good Sharpe ratio? Well, good is obviously a relative term, but in the hedge fund world, it's typically anywhere from 0 to 3 is what you consider standard. Okay, and what that means is anything below 0 is obviously bad, you're losing money. 0 to 0.5, or really anything below 1 is, in my opinion, not great, right? Most hedge funds would not be happy with that. It's typically what stocks can get, index funds, so there's no reason to trade strategy below 1. After you get a Sharpe ratio above 1, that's when it's considered good, okay? So you can typically have a decent-sized hedge fund raise a few $1,000,000. You're going to have pretty decent returns. You can also do this simply by trading options, and I've had a few option strategies myself get above 3, which we'll talk about in a second, but nonetheless, most iron condors, option selling strategies can get you there. Once you start to get to above 2 or 2 to 3, you start to get very good. You have a very solid fund. Most hedge funds in this range can probably raise multi-millions, if not $100 million plus. And then obviously above 3, that's when you get extremely good hedge funds. You're able to raise billions, and a lot of investors are going to be happy to give you the money if you have a lot of data showing live results with above a 3 Sharpe ratio, because you're making a lot based off how much you're risking. And that's typically in the market making or HFT space. Now, again, you can still get these returns with manual trading. You can get these returns with options, with, if you're just very good at buying and holding the right stocks. It doesn't have to be these ways, but typically above 3 or anywhere above 2 is a extremely good Sharpe ratio, extremely good strategy, and that's something that you would want to be happy with and move forward from there. So here's kind of a real example of what an option strategy could look like. So let's say you have a basic option strategy, one where you take an iron condor on SPY every single month, okay? And let's say these are the monthly returns, so 3%, 2%. Your average monthly return is about 2.65%. Annualized, that would be about 31.8%, pretty good. Your standard deviation of the returns monthly would be at 1.52%. So your annualized volatility would be 5.27%. Risk-free rate would be 5% annually. So if you go ahead and look at your Sharpe ratio, right, you take your percentages here, plug it into the formula, you end up getting 5.09. Now, this is obviously exceptional. This is an extremely good strategy. It makes sense. if you look at a strategy like this where you can consistently put out 2, 3, 4% gainers every single month, and the only time you lose 1.5% max, or you lose 0.8%, that's a very good strategy to have. That's typically the type of performance you're going to see in real option strategies. So why option strategies? How can you get a much higher Sharpe trading options compared to other strategies? Well, the main advantage comes from simply selling premium, because you get advantage of taking of risk and theta decay, right? And as long as theta decay is happening, you can take advantage of that premium decaying. You're able to make more consistent profit. And because of this, as long as you have good risk management, I'll keep this in mind, say it twice, as long as you have good risk management, you're going to be okay. And typically having defined risk, lower spreads, those type of things is going to allow you to get a much better P&L over time. So you can kind of see example as a manual stock trader, a manual trader, other types of firms out there, they can have a very extremely volatile P&L versus if you're just simply option selling and you have good stop losses in place, you can have a very more smooth out curve when it comes to how much profits that you're making. Now, there is one big downside that a lot of people don't tend to see when it comes to sharps, and it's typically like, we call it like a black swan event or these major events where, your Sharpe ratio is always going to be changing as your trades are being placed and as time is going on. And so high Sharpe can typically hide tail risk, right? So if you're selling naked puts, they may look really good on a Sharpe ratio until, it happens. And that is also very common with a lot of these strategies that have extremely high win rates, 60, 70, 80, 90% win rates. I mean, if you have a strategy that has a 90% win rate and your risk reward isn't good, well, when you have that one loss every 10, 50, 100 trades, whatever it is, well, that's going to really ruin your Sharpe ratio and make it not look as good, right? And the other thing is that there's non-normal returns, right? So options, again, typically, not always, but typically have skewed returns. So for the most part, if you're selling options, you're going to have a high win rate with low wins, or high win rate with low, profit per win. And then if you have a few big losses throughout, that kind of manage things out. And to show you just a few other option strategies in comparison. Now, again, these Sharpe ratios are all like, just for example purposes, it's not like if you just start selling credit spreads, you're always going to have a 1.7 Sharpe. Obviously, you need a strategy involved. You need to have proper risk management, stop losses, take profits. You have to know what you're doing. But typically, this is kind of what you can see on a basic idea of these strategies, right? So naked put selling at the highest. Iron condors are typically really good for Sharpe, just because you know kind of how much you're risking on every single trade. Same thing with credit spreads. And when you're naked put selling or you get covered calls, it tends to decrease. Same thing with just longing calls and puts. You're going to get a lower volatility doing these types of strategies. And again, you may not have the most highest return like naked put selling, which gives you the most annual return, but you're not going to be sweating these crazy drawdowns every month, every few days, like you would be in a simple iron condor strategy. And really, that's it. Now you have the ability to think like a quant when it comes to building your strategy and your portfolio of algorithms or manual trading, whatever that may be. And I really hope you enjoy this video. Please leave a like and subscribe down below. I'm putting out new videos every single week on this channel. I've been a trader 7 years, giving you all the insights that I have. So go ahead, subscribe, and I'll see you all in the next video.